Here we are starting off the second quarter, and we're seeing it much like the end of the first with technology selling off. In your notes, it was interesting. You said that you don't expect 2018 to be a whole lot different from 2017 when all is said and done, aside from this volatility. What do you think has really remained the same here?
The comment I made, Julie, about 2018 was really in reference to the interest rate situation. We're not expecting a massive rise in long-term bond yields nor a plunge. And slowly but surely, central banks, starting with the U.S., are tapering their, or in the case of the U.S., tightening monetary policy. So that ultimately will lead to quite a significant change. We expect it to be gradual. And as for technology, some of those stocks probably got ahead of themselves. And as value investors at Causeway, we're looking for stocks that have been left behind, of which there are plenty, and maybe there'll be more by the end of the year.
And so when you're looking at those stocks that are maybe left behind globally here, what are the sort of key criteria for you besides just a valuation question? Are you looking for some key characteristics?
We are. The Causeway team searches for companies we consider to be very high quality and that they have excellent management, or if there was poor management, they have departed and been replaced by much more effective operators. Companies with financial strength above peers, companies with the potential to generate quite a bit of free cash flow, surplus cash that can be sent back to investors to reward investors for their patience. And then finally, a business that we think has some protection from competitors that can sustain its profit margins in the next several years. As we look ahead, that's probably the most difficult, given so much structural change haunts various industries.
So that's quite a few criteria, Sarah. Have you managed to find some within the domestic space, the domestic sphere? Have you had to go abroad to find some of those companies that comply with all of those criteria?
We can find them, Vonnie, everywhere. And yeah, I say that my colleagues and I are a little creative in how we think about this. We're organized in 6 separate global sector groups, and each one of our portfolio managers heading up the sectors has seen companies come across his or her screens that fit all those criteria, or at least should do, as they fix or go through what we call self-help. These companies are often engaged in some type of operational restructuring in order to improve their earnings trajectory. And the market has been so impatient. Equity investors have really just wanted a sure thing, or what they thought was, and that led to a tremendous amount of passive investing. So what may be different in the next several years ahead is that active investing and this concept of price discovery, where we as research analysts find companies in the throes of a turnaround, that is an act that becomes rewarded.
So can you give us some examples, Sarah, of some of these companies that you say are in the midst of a turnaround? And has the sell-off in recent weeks made you buy more?
Well, there are plenty, and I'd say we're balancing our client portfolios, both international and the global portfolios, to companies in restructuring, and then others that we think are really well situated but generate lots of income. And in the domestic, so in the U.S. market, one of those in the process of restructuring is a company called Verifone, known for their payment terminals. It's a $1.7 billion market cap company, so small cap. And it hasn't had good price momentum in the last year, and hence it was in that awful intersection of truly the worst stocks last year were small, and their share prices were flagging. Those turnaround stories will really interest us, because here's a company that's actively involved in the chip and pin type terminals. So the more and more, you're not swiping anymore, you're using your chip, and those terminals and the software that accompanies them, including the security software, all provided by Verifone, and their arch competitor Ingenico trades at a demonstrably higher multiple. So we think this business, as it generates more cash, we're convinced will be one that can reward shareholders in the future. And on the low risk side, there are a couple of stocks in Europe, namely BAT, the former British American Tobacco, now with a wonderful acronym. They're becoming a world leader in smokeless, or heat and not burn tobacco, which is, for all those finding tobacco offensive, a kind of pleasant alternative, not to mention the fact this company takes tons of market share. They grew earnings 24% over the last 2 years, and yet no share price increase over that time frame, which means they've been derated, and we think trading at less than 70% of the global consumer staples multiple, that's too cheap. Great business, 8% annualized earnings growth.
And when you look at a company like BAT, is there, yes, it is so-called smokeless tobacco or heated tobacco. Is there still regulatory risk there? Because that's a sort of part of the industry that is still very early on. It's something regulators have not yet paid that much attention to, but there are some sort of murmurings of calls to do so.
Well, we believe that the regulatory environment is very beneficial for heat not burn type products, and being the world's #2 and possibly soon the world's #1 in that area puts BAT Industries in a rather good position. We much prefer them to be leading in that new technology in smoking as opposed to the old technology, which may very well be regulated right out of existence.